How are regulatory change, data transparency, and deal innovation converging to reshape private market access for both institutions and individual investors? I'm Jamil Sheppard, head of FactSet's Content Intelligence Lab, and today with our guests, we discuss the key trends for greater private capital availability, the growth and scale of large private companies, and the growing need of a broader investor base with more sophisticated data tools. This creates opportunities, but also new challenges for investors. For this discussion, three leaders at the heart of this transformation have joined us. Kendra Brown, Senior Director, Banking and Sell-Side Research at FactSet. Michele Lieber, FactSet's Global Head of Government Affairs and Regulatory Strategy. And Brooks McFeely, Founder and Chief Executive at MT Newswires. A very warm welcome to everyone.
Thanks, Jay.
Thanks, Jay. Thanks for having us.
Thanks for including me.
Glad we're all here together. Now let's dive into the discussion. Our first topic is the August 7th Executive Order, Democratizing Access to Alternative Assets for 401k investors, which now tasks regulatory officials to allow 401k investors access to private equity and alternatives. There are far-reaching implications for investors and providers alike. So let's start in Washington. Michele, can you walk us through the motivations behind the executive order? What happens next? And what are you hearing from policymakers?
Thanks, Jay. We saw a preview of this policy change in 2020. The first Trump administration issued an information letter suggesting that federal action could potentially encourage investment strategies that plan participants would be able to use alternative assets. Then fast forward to the August 7th executive order. And the Trump administration's executive order is the most significant expansion of U.S. retirement investments in decades. The policy change sheds light on the potential growth and diversification opportunities beyond traditional stocks and bonds. Now we will have access for plan sponsors to be able to utilize other types of private market assets, including crypto and others. I will say that the task is an important one going forward for implementation of this executive order. And in a way that will help foster innovation while ensuring market integrity. Plan sponsors will still have to meet significant fiduciary obligations to provide due diligence and to use their best judgment on their investment strategy going forward. The next step in the implementation is for the Department of Labor and the Securities and Exchange Commission, in consultation with the Internal Revenue Service and the Secretary of Treasury, they will all have to propose new rules for fiduciaries. This executive order does not in any way amend the pension or securities laws. So stay tuned for that to follow.
Protection for retail investors is always a top concern. What guardrails or risk mitigation strategies are in discussion among regulators?
So these changes could have significant implications for the duties and compliance obligations of plan fiduciaries under ERISA, as well as they could significantly affect disclosure and conduct standards pursuant to federal securities regulations. So it will be very important to see how they meet those obligations going forward in terms of how do you implement to be able to foster the innovation that everybody wants, but also to provide guardrails from a regulatory perspective so that fiduciaries still have a plan going forward of implementation.
Michele, if the US sets a precedent here, where do you see other global regulators heading on this issue? Is there potential for a worldwide opening of private market access, or is the US an outlier?
I do think that this could set the stage for additional activity in this area in other markets. I think a lot of countries are going to be looking at how the US implements this. I do think, though, that it's going to be really important that the SEC disclosure and reporting requirements provide interoperability between the public markets and private entities. And just by chance, it's been a great development that CUSIP Global Services has announced recently an expansion into other markets to enable them to provide a backbone that fiduciaries will need as they prepare to set up the infrastructure to manage private market assets as required by the executive order, and then subsequent regulatory implementation. And this model could be replicated elsewhere in the world.
Kendra, before I get your take, I want to quickly spotlight two deals that really bring this private markets go public idea to life. Just recently, Morgan Stanley jumped into pre-IPO trading with their Equity Zen acquisition, making a major move to give investors access to startup shares ahead of a public debut. And on top of that, Schwab is picking up Forge Global for 660 million, which really shows how mainstream firms see private share platforms as a bridge between private and public markets. So with these shifts happening, and given you're chatting with banking execs every day, how are these firms rethinking their advisory game as the lines between public and private exits start to blur? And what changes are you seeing when it comes to the timing and scale of those PE exits?
Thank you, Jay. That's a great question. And really, what it highlights is that investment banks are bridging the gap between public and private exit opportunities by equipping their clients to move between IPO, secondary transactions, or strategic sale pathways that reflect the market dynamics that you pointed out. The rising use of alternative financing, such as private credit and asset backed solutions, is enabling sponsors to create liquidity options outside of what we've seen in traditional public markets. They are evolving their teams and ensuring they have diverse capabilities, integrating M&A, capital markets, and private capital solutions to help clients assess the full spectrum of client exit opportunities. What's exciting for me in the seat that I sit in is that technology is at the core of this. There is a high demand for those technology platforms that you highlighted that support data driven approaches and meet liquidity needs while mitigating risk. We are seeing a focus on transformative change and AI adoption across banks to really seize this moment and provide transparency, the lack of which is a major concern for investors. As you pointed out, major banks are acquiring private share platforms to meet investor demand for firms that straddle the line between private and public realms and mix liquidity options for exit strategies. They're also deploying sector specific AI tools for due diligence, buyer sentiment tracking, risk analysis, scenario modeling, and automating complex deal processes. It really is a time of creativity where we are seeing increased focus on hybrid exit approaches that navigate these complex transition environments, where a company may simultaneously consider public listings, recapitalization, or private sales to meet liquidity needs and exit constraints. What this means for the exit, for PE exit, is that it's a mixed bag right now. While it's speeding up for high quality assets, overall exit volumes and hold times reflect a cautious optimism and backlog that will require innovation in liquidity solutions. Overall, PE exit activity has accelerated in 2025, and this has been led by mega deals and select high quality asset sales, with exit value surging over 69% when you look at it compared to 2024. However, exit counts have lagged slightly behind as the market still remains uncertain and investors become more selective. What this shows us is that buyers are focused on quality, which is leading to exits driven by higher, more strategically significant deals, while many portfolio companies, including some of the tech unicorns we all read about, remain on the sidelines waiting for stronger market confidence.
The FactSet business unit you head up uses granular market maps and transaction data for spotlighting M&A trends. How has your approach evolved to meet private market demand? What services are you seeing the most rapid growth?
This has actually been a journey that we've been on for several years. FactSet has expanded our coverage of private market data, adding tens of thousands of new profiles globally with deeper financials and connecting it with our wider content ecosystem to provide ownership data, fund commitments, and transaction histories, targeting gaps in private credit, real estate, and venture data. We've launched intelligent deal mapping tools that integrate AI algorithms to surface deal trends and connect disparate data points across private and public transactions. FactSet has always been a multi asset class solution, and this connected network view is increasingly vital for clients tracking cross market exits or hybrid deal structures.
Taken together, what's the potential for better private data? smarter deal intelligence and increased regulatory transparency to fundamentally reshape how the sell side supports these deals?
What we see is that enhanced regulatory transparency is supporting better risk assessment and due diligence, which streamlines deal preparation and pre approval processes in the increasingly complex cross border deal environments that we find ourselves in. This is transforming sell side advisory from process driven to insight led. Advisors can proactively spot deal windows, anticipate buyer behavior, and adjust strategies with real-time scenario modeling and compliance alerts. The connectivity of our private market data enables more precise benchmarking, peer comparisons, and valuations, which is all essential for sell-side professionals constructing deal pitches and customizing exit strategies. Taken together, these advances position us to fundamentally reshape deal support and improve the speed, accuracy, and confidence of our clients.
Brooks, let's shift gears and talk about what you're seeing in the market lately. You mentioned there's been a noticeable uptick in demand for private company data and news from asset managers, banks, and wealth firms. We're picking up the same trend with our weekly street account recap on private company news. There's just way more buzz around the private market headlines than we saw even a year ago. What do you think is fueling all the interest? Is there a main theme or story that really stands out to you right now?
Most importantly, and maybe certainly from our perspective, providing additional transparency on KPIs, company level information that historically hasn't really existed at scale is growing fast. We are, have taken the lead in providing transparency in the news area, news space. We cover U.S. private companies and provide information as a result of speaking with and interviewing these companies directly in their C-suite contacts to get really good insights on these companies. Private companies don't have disclosure requirements, of course, that public companies do. So there's been a tremendous sort of information and insight vacuum around the private companies. So that's changing. We're growing fast in our coverage. Obviously, FactSet's done a nice job and pulling together, KPIs and other, insights on these private companies. That's essential for investors to have confidence in what they're investing in. There's fewer IPOs in the public markets than 20, 30 years ago. There's fewer public companies than there were 20, 30 years ago. Significantly fewer, in fact. Also alluded by Kendra earlier. Private companies are staying private longer. So a lot of that, valuation expansion is happening outside of the public market. So there's an increasing interest, obvious interest in getting into these companies earlier and benefiting from that expansion. CalPERS recently, one of the largest investors in the world, the largest U.S. pension fund, recently announced expansion of its exposure to private markets, private companies. So that provides a lot of sort of momentum behind this asset class. Individual investors, are eager to get in. There's prestige of access. Advisors are hearing from their clients around, how do we get exposure to SpaceX and OpenAI, and for investors that get access to those companies and exposure to those companies, there's sort of like feels like an exclusive club. The retail firms are getting into the space, obviously through those acquisitions. Robinhood announced over the summer a tokenization of U.S. private companies and making that available for EU customers on their platform. So there's a high level of interest across the board in getting into this space. Asset managers, ETF issuers, we're trying to find ways of creating ETFs to provide the retail market and others with exposure to this alternative asset class. There's obvious opportunities there, but there's still a lot of work to be done. There's tremendous friction still in the marketplace around getting exposure, getting access to these companies is not easy.
Hey, Brooks, how do you foresee private market media and data coverage evolving to rival what public equities achieved decades ago? What's necessary for private market legitimacy in this new era?
Yeah, I mean, it all comes down to, frankly, transparency. No asset class has really been able to survive to any significant degree in a vacuum, right? So as a media company, as a news company, we need to provide that transparency in order for private companies and this particular alternative asset class to really thrive. It simply won't, in the absence of information investors need in order to determine whether it's companies growing or not, debt levels and so on. So our role is, I think, essential in this space. We're the only ones that have really taken on the prospect of covering private companies at scale across all sectors, and we're having some success. Not easy getting private company CEOs to talk to our reporters and give us insights on the balance sheet, product sales, sector themes, and so on. But we're having some success there and getting some really good insights. I think that's going to help liquidity conditions for these companies and for the sectors as a whole.
Now that we've discussed the regulatory work underway to allow private market investments, the data revolution, and deal making innovations, I'm hoping before we close that each of you could share what you're watching for in private markets over the next 3 years. Let's begin with you, Brooks, and then Kendra and Michele to follow.
I think what we're watching most closely, is the retail broker and the retail investment community, and what sort of dynamics are going to occur there with new tradable assets that would give essentially investors that are don't meet the definition of accredited access and exposure to this private markets and these private companies. Still, there's a lot of interest in the space. Obviously, again, Robinhood's announcement and so on around trying to make derivatives or tokenized versions of SpaceX and OpenAI. Not really sure if that's the way it's going to happen. There's a lot of, again, friction around getting direct ownership in these companies. The companies really don't want to open up the cap table to millions of investors individually. So trying to solve for that sort of exposure and access is going to be critical. ETF issuers trying to figure out how do we bundle together a number of private companies and offer exposure that way. Not an easy problem to solve, and so we're trying to stay close to our clients, which are most of the large retail firms globally, and kind of listen to what they're thinking and how they're thinking about solving for this. But I would say that there's still a number of issues to solve on the retail side.
Yeah, it's striking. I mean, we got a 10x rise in AUM over the last decade plus in private markets. I mean, the explosion you're highlighting with the retail space, this democratization of the 401k investor and what they're allowed to invest in. It's really no telling over the next 3 years how this is going to really unfold, but certainly a lot more growth is probably to be expected. Very interesting. Kendra, what are you thinking about over the next 3 years?
For me, it's definitely the use of AI in core sourcing and due diligence, which will profoundly reshape private markets. Firms are already deploying agentic and generative AI to identify future acquisition targets with predictive modeling, analyze huge data volumes for risk and fit, and automate document review and data extraction, often shaving off weeks from traditional deal timelines. What we're seeing and what I'm really excited to continue to model is what I think is a make or break moment in this space. Deal makers who adopt AI platforms will have a competitive advantage as they establish smarter deal workflows that leverage deeper insights. And those who lag risk losing out as they won't be as nimble, as fast, or as informed as we continue to expect market volatility and regulatory shifts. Watching how AI continues to automate and enhance sourcing and diligence will be a must see for anyone tracking private market innovation and value creation.
And Michele, over the next 3 years, from a regulatory lens, what are you looking at?
I do think that there's going to be a lot of important developments, both from a regulatory implementation perspective, but also as we start to see legitimacy of certain assets, we will look for transparency. So we're going to look for transparency in private equity, and they are going to have more obligations of disclosure, I would probably expect, and also in the crypto markets. The crypto markets have been very closed, and folks have not understood as well. But I do think as they start to implement this executive order and we start to see more legislation coming out of Congress that could impact those markets, I do think that there will be an increased level of transparency and legitimacy for a lot of these assets.
Well, this has been an illuminating conversation with all of you. Thank you all for sharing your insights and perspectives. To our listeners, thank you for joining us. And you can find all of our episodes by searching FactSet Insight on Apple Podcasts and Spotify.
The FactSet Insight podcast is for informational purposes only. The information contained within is not legal, tax, or investment advice. FactSet does not endorse or recommend any investments and assumes no liability for any consequence relating directly or indirectly to any action or inaction taken based on the information contained in this podcast episode. The views shared by third-party contributors do not necessarily reflect the opinion of FactSet.